Okay, hello everyone. Today I have the pleasure of speaking with our man Andy Constant from Damp Spring. Andy is I would say, macro analyst. He's been around a very long time. Um, and like everyone, he gets some things right, he gets some things wrong, but he always has I think, an intelligent take on things. And I think in this time that we are in right now, with the markets doing things that arguably they've almost never done. I thought maybe getting someone in here that maybe has a good head on his shoulders and maybe kind of keeps it real. Let's get him in here and see what he has to think. Okay. Um, so Andy, welcome and thanks for coming on.
Thanks for having me.
Why don't you tell me, what are you seeing? What are you thinking?
Yeah, I mean, let me just start by saying, like, what I try to do and who I am. I've spent 39 years trading markets at some of the biggest firms in the world, Solomon Brothers. Ran my own hedge fund that did RV and worked at Bridgewater, worked at Brevin Howard, and the last half of my career, so I was mostly in single stocks and credit and things like that, vol. And then the last half of my career I was in macro. And what I do now is I really serve a number of audiences. Firstly, I manage my own money. I am always long in my long-term savings, a variety of assets, stocks, bonds, gold, everything you could think of, and always long. And I also manage a bunch of money of my money speculatively, trying to time markets, and I use a macro framework to do that. I also sub-advise three large hedge funds who have allocated me money to manage on their behalf within their framework. So I sub-advise them. And I also consult 20 large hedge funds, providing them with research and strategy um, and newsletter, et cetera. High touch with some of the largest hedge funds in the world. And then I also have a subscription model for a wide variety of clients that could be anywhere from do-it-yourself investors to high net worth money managers, RIAs, et cetera, and lurkers who are from the sell side, the buy side, and market makers, and some other newsletter writers. And so all of those things I do on behalf in the same exact way, using a macro framework that focuses on what's the outlook for growth, what's the outlook for inflation, what's the outlook for sort of risk premium, which is the combination of whether cash is a good deal or assets are a good deal, and then positioning, flow and positioning. Now, I don't do much with, well, I use it all the time, but I don't do much with what Jason does in terms of the short-term flows associated with the COT report, et cetera. I use all that in my process. I just don't weigh it that heavily because I'm not really trying to, my long-term assets, I just keep relatively passive. My high frequency trading is pretty low frequency. Like I make trades not very often, like very unoften, and infrequently. And so, what I try to do on that is use all of those things to put together a picture on markets. And right now, I agree with Jason. The picture is, I described it today. I have not seen a circumstance where broad asset classes, all assets, gold, bonds, stocks, are so rich in general, and more importantly, have the possibility of going significantly higher or significantly lower on a pretty digital outcome. And so I guess the big picture right now is I don't see a lot of value in owning assets, and yet I do see a very high likelihood that we could see something like rates go to 5% and then 3.5%, and stocks go to 7,500 and then 5,000, or vice versa, the opposite direction of those things. And I think that's going to play out in the next 15 months.
Okay. Um, I don't even know what to say to that. You got me tongue-tied. You may be the first person that ever shut me up.
Well, let me start with like sort of what I see as the economic outlook. I mean, you've got a complex economic outlook where I think for the first time in a long time, maybe even as far back as Nixon, the president is doing major things. Nixon did probably the most major thing that ever mattered in financial markets by leaving the gold standard and abandoning the Bretton Woods Accord, which allowed for fiat money to be printed, which allowed for a significant growth in our national debt, which we used aggressively in every crisis. And right now we have a president who is really trying some new and aggressive policies. He's trying to um, um, reframe global trade. He's trying to change the way we deal with immigration and our population. And he tried, I think he failed, but he tried to do a major rehaul of the size of the US government. Now, that's an ongoing process, but Doge really didn't amount to anything at all. And the OBBB was fairly stimulative. And though it cut a little bit of spending, it spent all that cuts in taxes. So there's some things that he promised that he hasn't delivered on. But as it relates to tariffs and it relates to reshaping global trade, reshaping our geopolitical outcome, trying to find peace in many regions in the world, those are big moving parts, and changing our immigration. Those are big moving parts. And so when I look at the world, I see the two big moving parts are the immigration bit and the tariff bit. And my view on tariffs is they're a tax paid by somebody. Who? That's unclear. But let me tell you something. It's really paid by everybody. It's paid by exporters, it's paid by importers, it's paid by consumers, and it's collected by the US government, which allows it to offset its national debt. So that's a fact. Those things, we can get into how much of each. And for that matter, we can get into, taco versus Liberation Day and all that nonsense. But in the end of the day, there's a tremendous amount of tax being collected, and that's having an impact on growth. And a tax is anti-growth. It's also short-term increase in inflation, which has not returned to target in, approaching 5 years. And so that's one thing. And then the other thing is immigration, which is shrinking our labor force, which is keeping our labor force in balance as the anti-growth tariff policies would normally cause job loss. The shrinking of the government would normally cause job loss, but the unemployment rate isn't changing because we're bringing in fewer people into the country. And I guess the last thing, that the big moving part that has nothing to do with the president, but is a meaningful impact on society, is the rapid investment in AI. And so we're seeing a historic CapEx buy. And that CapEx buy is partly related to the OBBB in that it permanently allowed for instantaneous depreciation of CapEx. But that CapEx is rifling through the economy and causing significant GDP growth, even though the job market may not be so great. So when I look out to the future, the big digital event is obviously where will tariffs settle? Will the Supreme Court deem them illegal? If they do, what will the remedy be to pay all these people that paid the tariffs back? It's regardless, it's going to be massively increasing our national debt. So that's one digital. The other digital is obviously, is the AI spend going to build overcapacity that will have to grow in, like what happened with fiber optic cables and compute in 2000, or is the growing going to catch up to the spend, and so that'll self-finance additional capex? My leaning is that the economy is priced for significant easing in financial conditions, significant ongoing budget deficits, significant growth, and inflation that stays relatively high. And those things have to deliver And AI has to deliver on its expense. Those things have to deliver for assets to do well. And they can very easily do well to the extent that they deliver. But that wouldn't be my call. I would expect them not to be able to deliver, which would favor bonds, particularly the short end, and um, would be negative equities. And so that's my leanings.
Okay. Um, I have been looking at this, and I enjoy macroeconomics very much as a subject. It's my favorite subject. Um, but I have been looking at this in two ways. To me, not macroeconomic wise, but macro, what I would call market wise, right? To me, there's been two things driving this stuff, right? If we get into the AI argument, right? You have, nobody in my view has any idea what this is going to look like in 5 to 10 years. I don't care what
Absolutely.
anybody says, okay? Anyone who tells you they know what this is going to look like in 5 to 10 years is selling you something.
Well, Jason, somebody is going to be right.
Well,
They're going to have
sure.
today.
I'll
It's
flip
going
a
to be
coin
right.
right now. No, I'll flip a coin right now. I'll call heads, you call tails. One of us is going to be right.
Yep.
That means
But
nothing
that's the
to
way.
me.
But that's the way it is, right?
Yeah. No, I get
Everyone has
that.
a bet.
No, I get that. But my point here is that I have no idea. Nobody has any idea what this is going to look like. Okay. But and clearly the obvious thing, the semi-obvious thing is what you're saying. If it ends up being this great thing, then markets probably go up. And if it ends up being not as great as people think and doesn't give as much productivity as people think, then we probably over discounted it and markets probably go down. Okay? Great. Same thing. Flip a coin, right? But my view has been no matter what this shit brings, okay, from a productivity standpoint or from a net present value of the investment standpoint and all that stuff, it ain't going to stop because it's not just a productivity investment in the economy. It's also a national security thing, right? I've been calling it Easter Island, right? Like they're not going to stop. They cannot stop, right? Because this is a battle for, who's going to be leading the world, right? Between China and the US, obviously, right? So it can't stop. Even if it has a negative net present value investment, um, it ain't stopping. And we see that. It's, everyone hates it's different this time, but it's somewhat different this time in that the government is making investments, as you know, in companies. Okay, they did that during the
They
Great
do that
Depression.
during crises.
Right, during crisis, it's fine. And I think that you're right that what Nixon did was it allowed the government to say, okay, crisis, okay, print money, okay, create liquidity, and that gets us out of it. And that's what happened in 08, 09, right? That's what they did. Whereas these guys now, as human nature would do, and as human nature has done in the past, these guys are now saying, why wait for crisis? Let's just pump the shit now, right?
Right.
Um, which ultimately leads to disaster, if you believe in macroeconomics, right? But it doesn't have to lead to disaster today, right?
Right. So you're talking about, and I think you're dead on, and that's certainly where the momentum in markets has come from, and the momentum is strong. You can't fade this. You can't fade it since I faded it. I've been wrong, but you can't fade it. And what's fascinating to me is all that's true about equities, and yet the bond market is super strong.
Yeah, I mean, this has been my thing, right or wrong, only time will tell. But I don't think that, look, let's assume that what we're saying is correct. And we never know 100% if what we're saying is correct, but let's assume that that's what's going on. All these people are pumping. The US is pumping. China's pumping. We even now have Japan join the party, right? Pumping, pump, 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 right? So that creates a lot of liquidity. It creates a lot of money. That money goes into something, stock market, gold, assets, something. They go up, right? Until the market says no more. We're not taking it anymore, right? We're
Right.
no longer
Right.
accepting all this currency, this
Right.
fiat
And the way
currency.
I think about that is, so what's the constraint? So what do we know? We know that the government is spending a lot, 2 trillion deficit a year. It's not increasing, it's staying the same. So on a rate of change basis, it's not going up, but it's still spending a lot. So that's putting out money. By and large, countries are central banks are no longer printing money. They're stopping QT at best. The private sector isn't printing money, meaning commercial banks, the banking system isn't printing money. So the money printing machine, the spending machine isn't driving it. What's driving it is incomes. And so what happens is that you and me, I'm sure you mess around with AI. You might have even bought a subscription or two, and paying money to somebody for their co-pilot or their Claude or their whatever it is. You're probably paying some money, and so is every member of your family. And you're fucking around with it, and you're enjoying it, and it's making maybe it's helping a little bit at work, but mostly it's fun. But you feel like you have to do it because you know that the guy next door is doing it, and you can't speak at a cocktail party intelligently without being part of it. And then at corporations, Accenture, a company that does consulting. My God, AI should absolutely replace that company. And its stock price acts like it should be replaced. So what are the guys at Accenture doing? They're spending on AI. And so the spend just to stay relevant. And so lots of companies, every company that isn't an AI like producer, like a picks and shovels or services, they're all spending on AI because they're the business next door, the Joneses, they're the Smiths, the Joneses next door are spending on AI and they have to stay to compete. And
Now,
so
look, that's why I call it Easter Island.
right. And now all this revenue's coming. It's going to the hyperscalers. It's the hyperscalers are like, shit, we need more of this. So they're buying more data center, which means more data centers and more things that make up data centers, like chips and all the various things that are part of constructing and building, and then the energy. And so all that money is flowing into CapEx for all those things. So now let's just, but recognize where it came from. It came from income. And the
Okay.
people that are doing the spending have to spend on the rest of the economy too. Like the increase in GDP from spending on AI has driven GDP, which means that other spending on food, shelter, clothing, whatever it is, the 98%, the 96% of the GDP that isn't tech is suffering, and the jobs associated with that are suffering. And so at some point, people are going to be like, listen, I spent all I can on AI. I'm not going to spend any more. And the companies themselves, the hyperscalers, what's happened to them is super interesting to me. So, firstly, Apple, Microsoft, Google, not Amazon, Meta are retiring their shares like crazy and have been doing that for 5 years. That takes money. Are they going to stop retiring their shares? They might have to because they don't get, there's less, the income doesn't grow. They're also spending down a huge cash hoard that they've had. All these companies have huge treasuries, cash, US dollar cash treasuries. Those have been coming down rapidly as the capex budget has been spent. And so to me, what certainly the markets can just say, or the government, or there can be a catalyst. But what really will do it is when the companies stop spending because they can't afford, they can't fund it. They don't want to cut their share repurchases, or they do, and their stock starts to fall. They aren't getting as much income growth, so they're, the cash flow financing of their capex stops growing, and then they run out of cash in their treasury. And so those are how you get the spending curtailment of this stuff. And what replaces that? Could the government then spend? Sure, but they have to finance it, right? So,
No, that's right. And that's why I think that, to me, the sign to all this, going back to that whole macro view, is when bonds fail, that's when I think we got trouble.
right.
When the market itself says no more, okay, no more. I understand you're going to spend whatever it takes because this is about, global security or whatever, right? So you're going to spend whether it's the private companies or whether it's the government. Somebody is going to spend the money because it has to be spent. Otherwise, we're going to lose our power to China or whatever, right? And that's all fine, right? And as they spend that, there's more money out there, more income out there, assets go up.
Yep.
Well, it's lovely. Um, but at some point, and I don't know where it is, but at some point, if economics has any viability at all, um, the market is going to say no more.
Right.
There's,
And
there's,
so then
there's a
you look at
limit here,
then
and
you
we're at it. We're not going to buy your bonds anymore.
right.
Okay?
And then you look at the 10-year note breaking 4% today and say, well, that's not happening. None of that
Not,
things you
not
just said
yet.
are not happening.
No,
And
not
so
yet.
when I look at that, I say, what's happening in the bond market? Like, what is it about the bond market that's causing that? And what else matters? So you look at Japan, you look at Germany, you look at the US, all of our long end of the yield curve is struggling. And you look at every currency, the US versus Germany versus Euro or versus Japan. Sure, I get how the US is weak and has been weak. It's on the front end of the spending, the front end of diluting its monetary base, et cetera. But the bottom line is people expect the governments to step in and keep bonds from cratering. And the only way you do that is by printing money. And
Correct.
so the printing of money tells you what's happening. And listen, gold's up 59% this year because everyone expects the bond market to be too important to the equity market, which is then too important to the thing you're saying on AI investment, such that all that has to happen is that the dollar gets depreciated versus gold. And so it's not a surprise to me. I love gold, always have. I actually shorted it today, but I love gold. It's a great thing for a diversifier. You have to own it in your portfolio. But up 59%, there's some discounting going on, and the expectation that the central banks and fiscal policymakers are going to protect their bond market at the expense of their currency. And I don't know if that's true.
I mean, they
Like
did so in April when things started to fall apart, right? And we started to see some dislocations in the bond market. That's when they came in.
100%. But
And this is what it
that
means.
was a crisis, right? Like to
Yeah.
me, it's like if you told me the 10-year was at 4.5% tomorrow, would I think that would really threaten the whole AI story that we've just laid out? No,
No,
it wouldn't.
no way.
Right? So, you know, to me, there's nothing like a crisis. There's nothing like the type of policymaker action that a crisis requires. But in the event there is a crisis, so then it comes down to the thing you said, which is, are they going to yield curve control at 4%, 10-year note? Like, do they
No,
really need? Do
but
they
they're
really
going
need?
to come in. They're going to, if something happens, okay? When something happens, right? I don't know, crypto blows up. The stock market starts to blow up. And in particular, in my view, the bond market starts to fail, right? They're going to come in. All right. So it's almost like, and I don't mean this necessarily as bullish, but they're going to come in, right? So you,
100%.
you you could be short from today. All right. The market acts like crap today, right? You can say, okay, the market is starting to act like crap. I'm going to get short. And you can get short and the market can go down. But one of these freaking days in there, they're going to come in, right? And when they come in, the market is going to squeeze higher, right?
100%.
And
100%.
you're going to be screwed. So to not be in that thinking, it's like, and this is where it's dangerous. You have to be long because there's no downside. Because if
Right.
there's
So
downside, they
so
just
it
come in
comes
and they support it.
right. So I did something. I put out my something that I've been famous for regarding the various islands we could go to. And there's this one island, Tahiti, which has a debasement section and has a run it hot section. The debasement section is not only do they come in on any dip, but they engineer the bond market to stay low yields. The other side, the run it hot, they let bonds sell off a little bit, but not enough to damage equities or gold. And you have to own equities and you have to own gold if you believe we're heading in that direction. Whether you own bonds or not, it depends. You have to assume they're going to come in on bonds before you take a loss. I think you're going to have to take a loss on a long bond position before they come in, but they're going to
Yeah.
come in.
Yeah.
So I think the short on bonds is probably easier if you really think they're going to, if then even longs equities and long gold, because both of them have moved a tremendous amount. So
I mean,
like,
again,
like,
my whole thing with this is that I can't, unfortunately, predict the future. I can't predict what markets are going to do, unfortunately. I can only look for risk reward and try and take it from that perspective, right? But my whole point with it is if shit starts to fall apart, we know they're going to come in, and that's fine. My whole thesis is if they come in and it doesn't work, then what? And I'm not saying it won't work immediately, right?
of
If the
course it
stock
won't
market were to
immediately.
drop 10% in the next 3 days and everyone started freaking out and the government came in and said, we're printing money, whatever, the market's going to go up after they say that. Okay.
100%.
But what happens if 2 days later it fails? Um, in other words, what happens if all that support
Well, that's
doesn't work?
I think the issue there,
That to me is the end of the world.
right? And I think the issue there is, and there are lots of guys. My old boss, Ray Dalio, likes to talk about this. There's this tipping point idea where you just can't take on more debt. And the reason you can't take on more debt is because no one wants to buy the debt at the yields it's offered.
Right. The market won't bear.
And the yields that's offered are necessary in order to support the economy. And
Yeah.
so in that circumstance, the only thing that happens is the government has to buy the bonds
Yeah.
and print dollars, which causes the currency to fall apart.
Right.
So
Which means if your
the
currency's
answer,
falling apart,
I
then
think,
how is anybody going to buy your bonds if your currency's
right.
falling
I
apart?
think the answer to your question is already pricing in markets, which is that scenario is bad for is not bad for stocks particularly. It's bad. It's if you in your own currency. It's highly inflationary and very, very good for gold.
Yes, which is why gold, I think, is doing what it's doing.
Right. So
Personally, that's what
the
I think.
question is are we on the cusp of that cataclysmic sell-off in equities that needs to then generate money printing, and that money printing is going to fail, and that means the Treasury is going to the Fed is going to have to print money and buy bonds, and if so, all of those things, each one of those things happens, then you got to own gold, and people are way front running that whole process, and none of
Yes,
it's
they
happened. Like none of the things we've just been talking about has
have
happened.
happened yet. No, and they may not happen.
And the odds, I mean, just whenever you do like a parlay bet or any sort of thing, even a parlay on flipping a coin times only wins 1 out of 8 times.
Right,
And people are expecting it to win 50% of the time right now in their gold investment.
right.
So I think markets are way and to some extent, but less so, their equity investment. I think markets are way in front of that doom scenario. But the doom scenario is on the table. It's just, less than 10% chance right now and being priced much, much higher than that in my estimation.
So if the doom scenario is a 10% chance and markets are pricing in a lot higher than that, then wouldn't we want to be long?
Want to be long stocks?
Be long assets. If they're pricing in doom and doom has less of a chance than they're pricing in, then we want to be
No, no, I'm saying they're pricing in 50% chance of doom.
right. But there's only a 10% chance of it happening. So wouldn't
Right, in gold particularly.
right.
In stocks, not, that's okay. They'll do fine if they'll do better if there's no doom. But part of the bid for stocks is the doom. It's the printing. It's the debasement. Stocks are a debasement asset, like people like to say. What's not priced at 50% likelihood of occurring is bonds.
I like that phrase that you just used. That stocks are a debasement asset.
Well, they have been throughout history. Throughout
Yeah.
history, when a country devalues its currency, stocks in local currency terms go up to the moon.
Yes, you can look. I've pointed this out many times, but you can look at what happened in in some of the South American countries, right, where their currencies got massively debased and their stock markets went up. incredible amounts, right?
Our currency is getting debased, and stocks are up, 35%, 40% in
Right.
the
Right.
and 70% if you look with any sort of longer term time frame.
And people,
So
I think, are so stock focused that, like, if they want to believe in this doom scenario, for lack of a better word, then they want to be short stocks, which is probably the wrong place to be.
yeah, to me, like as I said, in the scenario in which the government prints money, they and either controls the bond market or doesn't control the bond market, you want to be long stocks and you want to be long gold. Full stop. You
And
don't, but you want to be short the currency
yeah,
because you
and
can't you can't you can't get to 8,000 S&P with assuming AI is sort of as is. You can't get to 8,000 S&P without debasing the currency, but you will get there if you do. And you can't get to 5,000 gold without debasing the currency. So if you debase the currency, there are going to be some currencies that are being debased less, whether it's Swiss franc or
right,
yen, or whatever it
right,
might be.
right.
The
And that's
dollar is going to
exactly, I say all the time, have whatever theory you want. Okay, I don't really care what it is. Trade any way you want. I don't care what it is, but don't do anything until the market is agreeing with what you're saying, and then go with it, right?
right.
Don't
And so
don't
right
fight the
now,
tape, and that's exactly what's going on. What you
right,
just
right
said.
now, what's happening is a scenario that we've just laid out is the odds of it happening are increasing rapidly. Now, I happen to think they're way ahead of the probability of it happening, but who the hell am I? I'm just guessing, right?
Yeah.
What we know for sure is the odds of the scenario we just laid out have been increasing. And as an investor, the momentum would say, are they going to continue to increase or are they going to? And the answer has been for months now, yes, they're going to. The odds of this debasement are going to continue to go. But at some point, they get 100% priced.
See,
And
it's such an interesting time to me because, as we've been talking about, we're dependent essentially, I believe, on two things, right? Again, one is the AI miracle, which we have no freaking clue what it's going to look like. If it's going to be a miracle or if it's going to be a fiasco, right? Or if it's going to be something in between, which is probably the most likely event, right? Um, and two, how much can the government do? That's what we're relying on, right? We don't
yep,
know. How deep is the government well? We
right.
just
And the
don't know what
question
that
is,
is.
and the big thing, and I wrote a Substack on this going back to Nixon. It's extraordinarily rare, like never happened before, except potentially Nixon, that a government has decided to pump when things are good. It doesn't happen.
France.
Which case?
That's the one I always use. France.
Okay. Okay.
France, from what I understand, before the French Revolution,
Back then. Okay.
was on the
While.
gold standard, right?
Yeah.
They could only print as much money as the gold they took in. So they sent people across the world to go get gold so that they could print more money so Marie Antoinette could go build their castles. And then they wanted more castles than they had gold. So they came to the conclusion, hey, why should we wait for the gold to actually get here before we can print money? We know the boats are out there. We know they're going to be bringing gold home. So why don't we just print money against the gold that we know is coming, right?
Yep. Yep. So I agree. There
That's
have been
exactly what's
cases.
going on here.
Right. And what you're saying is that. So the question comes down to consequences. We know what happened to Marie or Antoinette. The
Yes.
consequences are what? I don't know. I think the let me tell you something. If I were a policymaker and I could pump without consequences, why wouldn't I?
Of course.
Right. So
I always say if I owned a money printer, I'd be running it 24/7.
well, it depends. You have to say it. It has to be without consequences. Like, and the question
They
is,
don't
are
give
there
a
any
shit about the
consequences?
consequences. What's the consequence of them not doing it?
I agree. There's an all there. There's that.
So they got to do it. This is all they know anymore. It's all they know. And now we have this administration, and I'm not taking political sides here, but that's what they believe, right? Like you said, this is the first time, other than maybe France, that they're doing this in good times because why not? Right? Why
Right.
not?
So we agree. That's what's happening. That's what they're
And
doing.
what is the consequence?
And now I'm saying is what
Horrible.
could the consequences be? And as far as I can tell, there's only one, which is
Horrible.
inflation.
It's horrible. The consequence to me, when the shit hits the fan, is horrible. But the question is, which we don't know. But what we have to be searching for is when does this shit hit the fan? You could have made this argument a year ago. And if that's what you were betting a year ago,
I don't know about that. I think
you're screwed.
a year ago, the argument I was making was Trump wants to shrink the government, wants to lower immigration, wants to tax like hell on by tariffs, and wants the economy to cool down and detox. Now, something scared the shit out of him in April. We get that. And since April, it's been nonstop pump.
I
But
mean, my personal belief on Donald Trump, again, I don't like to get too much into politics. I don't think he's any different than any other politician, except maybe a little bit more gregarious. I don't know the word, but is he wants to make as much money as he possibly freaking can. You know, I saw a quote the other day. The answer to 99% of the questions in the world is money, right? He wants to get as rich as he can. The way he's going to get as rich as he can is if assets go up. You know,
100% agree.
he's an
And
asset
again,
owner.
we understand the why. We understand he wanted to detox. Maybe he wanted to um, change policy a lot. Then he had his
It's horse shit.
moment in April, and it's been one way ever since. And so now we're coming back to the same question. Will there be a consequence? And so let me just play that out. So what are the consequences to Donald Trump? He could lose an election. Well, he's not going to run another term. Maybe he is. Maybe he's going to hand it to some relative or some, you
Right.
know, sycophant or whatever it might be, and
Right.
on we go. So he could lose the 2028, or he could be stuck and lose the 2026 and not be able to pump. And so okay, we know what his points are. He's got to win these elections. And so, what can cause him to lose the election? Well, certainly bad news, like the alternative to pumping, could lose him an election. People on the street without jobs, the economy in the toilet, all those sort of things. So we understand another motivation for him to pump. But
Yeah.
the other consequence is that he was elected partly because of extended inflation. And so the question comes down to is could the Republicans lose the election if a year from now inflation isn't 3%, we're running 3%, isn't 3%, it's 3.5% and going up. That's the consequence that could lose him an election. Now, I personally don't think that will be the consequence that'll lose him an election because elections aren't decided over the economic outcomes unless people are out of work. They're not, I mean, we can talk about the revolutionary power of wealth inequality, et cetera, as creating some sort of, but, half of the people that are not on the lower half of the K are Democrats and the other half are Republicans. And man, I have a hard time believing that more Democrats are going to come out to vote because of the inflation and more Republicans are going to flip to the other guy. I don't see it. So the question is, if we start generating a lot of inflation, the bond market starts selling off, does Trump lose? Well, if he does, then he's going to act. But if he
He's going
doesn't,
to
I
act.
don't think he's going to act. I don't think he's going to expect to lose the election because inflation runs hot a year from now. I don't think he thinks that. And
I,
so
I just think that they're going
I
to
don't think he thinks there are any consequences whatsoever.
Yeah, maybe. I just, I don't know. To me, they're going to do whatever they can when asset prices go down to pump it up. That to me is the whole answer. Things come down in particular bonds, they're going to pump to save that. And that either works or it doesn't work. And that's the answer to all of it. This is, to me, the only thing that is keeping this shit going, right? And if that doesn't work, they're going to keep doing it. And if that doesn't work, then it's over because
Right. So it comes down
there
to
is nothing left.
right. So it comes down to listen, I'm always
There's no
long.
other bag of tricks.
I'm always long, fine. I think the returns suck nowadays, so I'm not really expecting much. But sure, stay long is always a good idea, and maybe a particularly good idea now. I don't think it's a particularly good idea now, even because of where things are priced. But they aren't going down in your local currency terms under any circumstance if they keep pumping. So a short because
Until
of
they do.
right, of course. Right, of course, because ultimately markets do get overbought and permanently overbought and markets stop. Um, so the question is, what do you do as an investor? As I said, market timing is fucking hard, and you're better off not trying it. But if you're going to try it, to me, you recognize that they're going to come in. But the question you have to ask yourself is, what levers can they pull tomorrow without a crisis? Like, I get they have tons of levers and they're going to come in a crisis, but are they going to continue to pump? Is it just the fact that they are have keep raising the strike of the put that gives you confidence to own assets, or is it because the put will never be tested? They'll never allow it to even get close. And if you think the second, that they're never going to even allow a crisis to start, you can't be short anything except
No,
except the currency.
right. That's right. And again, it goes back
I
to
think sentiment.
is it 100% up to them? It goes right back to that same question, right?
Well,
Is the government endless? If it's endless, then that's the answer. There's no downside. If there is some limit to it, then they're going to reach it because that's what they're going to try and do. Whether that's tomorrow or whether that's in a year or whether that's in 5 years or 10 years, I don't know.
it's
But
very fair. That's
they're going to try to find it.
a fair idea. And so,
And if they find it, look out. Ray Dalio time.
yep,
And I don't know. There's no way to know.
right. And that scenario is when stocks go down, bonds go down, and the dollar goes down.
Thank you. That's been my thing. The people who listen to me. Let's say it again, folks. I say that all the time, right? That's been my theory forever. I said, that's what we're watching for here, right? And let it happen on a day when they do come in
Right.
and,
And it
and get
fails.
involved. And
I
it
mean, it's
fails.
like Argentina most recently. They've came
Yes.
in twice, both times it's failed.
Correct. Thank
That
you.
tells you more about whether they're doing it enough and whether the market thinks that they can do enough than it
Exactly.
says than anything else.
Exactly. So to me, that's the answer in a way to all of this. The issue with it is that the answer being they come in, they intervene, however they do it, they pump, however they do it, cut rates, print money, whatever it is. Stocks, bonds, and dollar fail anyway. You can kiss the baby at that point. The problem with that is for them to come in and do that, they're not going to do that here. They're going to do that when things start coming down first. So you're not going to be able to get out at the top here. You're going to have
Right.
to, the market's going to have to come down 15, 20%. And then they come in and try
Right.
this.
By the way,
Then it fails.
at the
And then you
time,
get
the
in.
bond, and when it does that, and we're starting to see a little bit lately, when it does that 10 or 15% drop, bonds are going to rip. So what the
How's they
thing
doing
I'm
today?
most, as they're doing today, the thing I'm most interested in from a tactical macro standpoint is shorting bonds when the equity market tilts. I don't equity market, there's so many moving parts. I have a view on the equity market, but that can change tomorrow. But
Right.
the one thing I'm focused on is in the event the equity market sells off, bonds will inevitably rally on that sell off because that's the way it works.
Yes.
That's when I want to get short bonds in size
Well, that's
because
today.
if they come in, okay, bonds don't have much upside. But if they come in and fail, bonds have a shitload of downside.
Yes. It's over at that point.
Right.
And I've been saying that, God knows, I did a video 2 years ago about this very subject. And I wasn't saying 2 years ago that this is the time it's going to happen or anything, but I said, this is exactly what we want to
Right.
look
And
for.
that's the big
If you're
thing.
bearish, this is what you want to look for before you put on
Right.
bearish bets.
And you led off today with this is historic.
Yes.
Have we ever seen anything like that? I've been doing this 39 years. I've never seen anything like it. And I'm not trying to say there's an AI bubble. Oh my God, just don't try not to be so narrow-minded to think that we're only talking about the stock market on this program. We're talking about the world and all financial assets. When you
Yes.
look at the whole picture, I've never seen anything like it. And the outcomes
Huge variance.
could be very historic.
Yes.
Like I could imagine, and I've been saying this for the last month or so. I love tails, upside and downside tails. I love them in most assets because while they get priced fat, the nature of where the imbalances that we have right now are historic. And we're going to go to one of those extremes. I don't know which one, but we're going to go to some serious extremes. I think we're going to look back at 2026 and say, holy moly, this one's going to go down for the ages. And so, yeah, I think you have to be with your alpha trades, you have to be, you know, able to fade when things are in extreme, but then rapidly get out on the way back. And on the other hand, stay long assets until the event because assets pay. And that's the way I'm approaching this. But be really prepared to take a significantly change your mindset sometime in the next 15 months.
Okay. Sounds good to me. I mean, I'm in the mode here of as people are levering up into this, I'm taking stuff off. I
Yeah.
don't I don't think there's a big I don't think there's a big
I'd raise
I
more
really
cash.
yeah.
If I wasn't in my maximum amount of cash right now, I'd raise more cash.
Yeah, I don't think there's a big edge here. I really don't.
Yep.
I'm not saying get short here. I'm not saying it's a bubble here. I think the whole bubble talk is ridiculous to begin with. What is a bubble? No one can even tell me what a bubble is. So until you can tell me what a bubble is, I can't tell you if we're in a bubble. But what I do know is we've been in a bull market. And until it's not a bull market anymore, and I talk a lot about what that means to me, but until we're not in a bull market, I don't see the reason to be short. And if you think that it's the downside of what we've talked about here, you think AI is not going to live up, if you think that the government is going to cause inflation or whatever, blah, 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 and you think that the whole thing is going to go to hell, well, then, you know, why do you need to short here? Because the downside is massive in that situation. So if the downside is 70%, if this is a bubble, then that implies the downside is 70%. So if you believe we're in a bubble and we're going to lose 70, 80%, why do you need to short it right here? You know what I mean? And keep fighting
Yeah,
the tape.
again, it's a matter of your horizon, right? You know, if you're trying to squeeze out 3, 4%, you could be
Right.
long or short. I don't know. Whatever your process is that can squeeze out 3 or 4%, that's my process. I try to squeeze out 3 or 4% moves. I don't try to squeeze out 70% moves. But if
Right.
you're trying to catch the next trend, the trend
Right.
is still up
Correct. For now,
for now.
until proven otherwise. Awesome. All right. Well, I appreciate the talk. I think it's interesting. I think we're pretty much on the same page in a lot of ways. Um, I think we've laid out for people what to watch out for at the very least under the different circumstances.
Yep,
And I think we agree that the outcomes here are very binary.
very binary. You know, the next thing to look at is going to be these tariff talks at the Supreme Court. That's going to be the next big
Is
thing that no one can predict. Like
the
no
next
one,
the next
I
task.
wouldn't believe a word out of anybody that tells me which way the court's going to go. But if they go somewhere, that could have a meaning. They're going to go somewhere. One way, they're going to either make them legal or then we're going to make them illegal. And
Right.
that's a digital, guys.
When is that? Do we know?
November 5th is when oral arguments start. It's very likely that that could lead to a decision before Christmas.
Hooray. So we got some more fun heading into the year end. So we will see.
Yep. Well,
Andy,
thanks for having
I
me.
hope that we can have you back on and talk about that maybe at the end of the year or maybe at the early next year. That would be great. I love having you on. Um, I did notice you got sick of Twitter for a while there, and I don't blame you. I think Twitter is one of the most,
I came back
one of
with,
the
I
most,
come back with a good attitude. It was
I
good.
think Twitter is one of the most ridiculous things in the world, quite frankly.
It was a good break. And,
It's ridiculous.
I just have a good attitude coming back and, you know, fight the troll instead of engaging with the trolls. It's just stay away.
You can't because you know everyone's a hero when they can hide behind being anonymous. You know, they love it. They can get on Twitter, they can rip into you or me or whoever they want to rip into because nobody knows who they are. They don't even have the balls, right? They don't even have the balls, and they rip into people that have the balls to take a view, right or wrong. Listen, everybody's right sometimes and everybody's wrong sometimes. It doesn't mean a damn thing. You know what I mean? Like that's
It got to me. I
that's,
didn't. The reason I
that's the
left
nature of
is
the beast.
the problem is that's all true. The trolls are bad. All those people are bad, and the Twitter's bad, and it's toxic and all that. But in the end, it's up to me to decide how to deal with that.
True.
And I wasn't happy with how I was handling it.
Yeah.
And so taking a break, let me come back with okay, I know how to, I want to handle it now.
I
And
mean, I think that it's
hey,
natural for a 50-something-year-old man who has had a pretty stellar career in Wall Street to take some defense to a bunch of 22-year-old kids who are making money leveraged long in a bull market. You know what I mean? Like, talk to me in 5 years, kids. Talk to me in 10 years, kids. Everybody can make money in a bull market, right? The question is who gets to keep it, you know? And we know because A, I've been there as a kid myself, and I've witnessed hundreds and hundreds and hundreds of people go through this process. They're not going to keep it. It's just that simple, right? Um, but in the meantime, they can sit here and hey, boomer, you suck and you've been wrong and I've been right and it's like it's frustrating to listen to this because ultimately what's going to happen, and they don't, and it will happen, and it kind of happened to a bunch of the crypto kids just on Friday, right, where
yep,
we saw these people blow out. So just stick with it, man. You're a smart guy. You know what you're talking about. You're going to be right. You're going to be wrong, just like all of us, and these people on
absolutely.
Twitter.
Hey, Jason, one question for you.
Dude,
What are you doing with COT and reports not coming out?
I have no positions on.
So you're just on the sidelines. That obviously makes complete sense.
I mean, I've been long stocks based on COT since April. Got out of some of them a few weeks ago as people started to get more long, um, and got out of the rest because the COT
That's your indicator.
went away. So how am I supposed to trade when the data that I like to use is
Be
gone?
interesting. It'll be interesting to see when when everything comes back. I'm not optimistic, I must say,
Not
but we'll see
optimistic in terms of what?
when it comes back.
Yeah. I mean, we
But
went
I
through this
think,
before. We had a 5 week period where it didn't come back. This one could
oh,
be
is that
long.
right?
Yeah, yeah, a few years ago. I
Yeah.
don't know. I have no idea. I have a daily algo that tries to create
Sure, of course.
COT on a daily
Yeah.
basis.
Yeah, me too. Yeah.
But the but
You have
the,
to.
but the longer we go, the more error that algo is going to have, right?
100%.
I try to judge it as well based on what I'm seeing, what I'm hearing, what I'm seeing in some of the sentiment numbers and all that, But the sentiment numbers are not really improving. In fact, you look at the AAII today, which is not necessarily the greatest thing in the world, but it's maybe indicative. They got more bearish again.
Yeah.
So that doesn't make me think that they're getting long stocks here yet, I don't know. Um,
Yeah, that's the right thing. I mean, a lot of us, I don't depend on government reported data as a huge part of my process, but it's enough that all I'm saying is that as long as I'm not getting it, I'm less certain. And as long as I'm less certain, I'm smaller.
yeah, I think you have to be smaller here. I have to be smaller here.
Appreciate the time. And hopefully this stuff comes back soon so we can get back in business. Sure.
All right, but thank you for coming, Andy, and we'll talk again soon.